Stagflation. The S word might even be more offensive to your portfolio than the R word, recession. Hello, I'm Michael Hainsworth. The markets fear we'll see both a stagnant economy and inflation. One or the other can be managed. But how do we as investors make decisions when persistent inflation is eating away at low growth returns? Say hello to Myles Zyblock. He doesn't just read markets, he reads the mood behind them. As the chief investment strategist at Dynamic, his role is part economist, part storyteller, part risk navigator. And he isn't buying the stagflation argument. What's that one thing that an investor needs to know going into the home stretch of 2025?
I think that the one thing investors and their advisors need to keep in mind is that investing is a marathon, not a sprint. You know, as Warren Buffett has said, in order to succeed, you must first survive. So, okay, that wasn't one thing, that was two, but there you go.
Hey, if you were an economist, it would have been 3 sentences.
Yes.
Coming up, how to invest in this age of uncertainty. But first, tariffs aren't just headline fodder. They hit your portfolio where it hurts. There are both direct and indirect hits. Directly, stock prices tend to fluctuate. Indirectly, the increased cost of doing business fuels inflation. And overall, the uncertainty a tariff war creates leads to slower economic growth as companies choose to sit on the sidelines. When they choose to wait out the economic war, they're not investing in their company or their country. And we don't have to go far back into history to see the impact this can have on investors. In 2018, when Donald Trump instituted a 25% tariff on Canadian steel and a 10% price hike on our aluminum, shares of Stelco were almost cut in half within a year. Higher costs for basic building materials, like the ones Stelco makes, get passed on to consumers. Everything from cars to washing machines suddenly become more expensive, fueling inflation while taking spending money out of our pockets. High inflation often leads central banks to raise the cost to borrow money through higher interest rates. This takes the hot money out of the economy and cools inflation. But it makes it more expensive for a company to expand and in many cases pay its employees. The most common strategy? Ride out the uncertainty with confidence with a portfolio that includes a strong mix of high-risk assets that grow your profits when times are good and low-risk assets that help you ride out the uncertain times. Because making short-term investment decisions based on every new headline rarely works, even for the pros. Myles Zyblock has decades of experience interpreting the macro forces that drive market cycles. He's known for distilling complex economic realities into actionable insights. His latest outlook paints a picture of a world in transition, one where policy uncertainty lingers, tariffs are an unwelcome guest at the inflation table, and the resilience of corporate earnings holds the equity floor. Investors and advisors turn to Zyblock for a reason. He connects the dots between geopolitics, policy shifts, and portfolio strategy. And he does it without losing sight of the human side of capital markets: confidence, caution, calculated risk. And that's why I wanted to introduce you to him today. Myles, great having you with us. Thank you for your time.
It's my pleasure to be joining with you today.
Let's get right into this. How has global GDP growth changed in 2025 compared to the initial expectations?
The global economy finds itself grinding through a state of sluggish activity. The year began with most Wall Street economists expecting something like 3% for the rate of GDP expansion. And to give you a sense of what that means historically, the long-term growth rate for global GDP, say over the last 40 years, has been about 3.4%. But those growth estimates have been trending down from the early part of the year, and now sit closer to 2.7%. So this represents below average growth when looked at historically, not disastrously slow, but slow nonetheless. And I guess it shouldn't be too surprising, given a landscape over the past several months, which has been characterized by a heightened sense of policy uncertainty.
Is this really all about the trade chaos that we're getting out of the U.S. administration?
I believe U.S. trade policy has played a meaningful role in these growth downgrades happening throughout most of the world. The associated uncertainty has encouraged households to spend more cautiously. Perhaps the bigger impact is found in businesses' capital spending plans, as the ecosystem has made it difficult for companies to commit the resources necessary to fund large capital projects. The notable exception is found in tech, where large investments in artificial intelligence are ongoing. But it's not, just the policy uncertainty; it's the actual taxes which provide a drag on growth. And remember, a tariff is a tax, and we're now seeing that a 10 to 15% tax on U.S. imports is the new 0% rate, regardless of where those imported goods might be sourced.
So it sounds to me that we are at risk of further GDP downgrades if we're seeing companies pull back, the uncertainty leading them to keep their powder dry, essentially. That has a long tail impact on an economy.
I think we're past the period of peak policy uncertainty. I'm not saying that it's going to be clear sailing from here, but the worst is probably behind us. There have been several trade deals struck, at least in principle, and America's tariff rate schedule is now reasonably well understood. We can also appreciate that some bilateral trade talks are ongoing, so things could get even a little better from here. Less uncertainty, at least at the margin, is better for global economic activity.
I wonder if I'm just sort of suffering from a very Canadian problem of being too American centric. Europe's spending money on infrastructure, defense as well. China has started to stabilize its housing market. What about the rest of the world?
What you're talking about here speaks directly to, I think, another reason why the global economic outlook might have hit bottom. Aside from hopefully being past the peak in trade policy uncertainty, there are other supportive policy actions to consider as they filter through the system. The U.S.'s One Big Beautiful Bill Act, which recently passed through Congress, might add a couple tenths of a percent to GDP growth in the later part of this year. Europe, given its much larger commitment to infrastructure and defense spending, could be additive to global GDP. And like you say, in China, where growth has been held back by a number of supply side challenges, the policymakers there have taken some steps to stabilize the economy and the housing market. This is all happening in the context of ongoing interest rate cuts from the world's major central banks.
And I think we're expecting more interest rate cuts, particularly in Canada, maybe the Americans as well. And with that in mind, though, I'm concerned about growth slowing, inflation not being tamed, and the tariffs that we talk about in the United States fueling inflation, particularly in the US, and of course everywhere else where we're suddenly having to deal with the increased cost of buying American. Why shouldn't we be worried about stagflation? That seems to be the big word that everyone's talking about right now. Why aren't you?
I mean, stagflation. I don't think we're in a period of stagflation in the original sense of the word. Stagflation was a term first used in the mid 1960s. I think it was a British politician who actually used the term first. And then it gained greater acceptance throughout the 1970s. And that was a period, if you recall, that was a period characterized by high unemployment, high and rising inflation, and stagnant economic growth. And, while the unemployment rate has been rising in several countries these days, it remains very low by historic standards. Growth is below par, for sure. I just mentioned that, but it's not near 0% growth. Meanwhile, inflation, while perhaps receiving a bump higher due to the trade frictions, is not historically high or accelerating in any meaningful way. So, while we're experiencing slower than average growth and somewhat higher than desired inflation, I don't think stagflation is really what we're dealing with. It's a catchy word for sure, but I don't really think it's what we're living right now or what we're likely to live in the next little while.
The absent part of that stagflation formula is the employment side. I'm wondering, though, if that's an avalanche that's about to overtake us. We've seen a ton of layoffs recently in tech, despite the strength that we've seen relative to the broader equity markets. And if we continue to see these tariff wars, courtesy of the United States, a lot of Americans are going to find themselves with pink slips as well in the not too distant future. Is it going to be a lean Christmas?
Well, we just saw the Canadian employment data not too long ago, where I think we lost something like 40,000 jobs in Canada in the month, and in the U.S. over the past 3 months, employment has averaged about 35,000 jobs. So we're already kind of in a very soft period for labor market activity, and could it soften a little more from here? For sure. But again, terms like avalanche, I don't really see that. I see where the tariffs are creating frictions, uncertainty is creating frictions, and this is all leading to sluggish, likely even slower growth ahead. But we're not talking about the great financial crisis or anything.
So this is my 30 years of media trading telling me to look for the sky is falling.
Well, everyone likes to look for where the sky is falling, but the sky doesn't fall too often, does it?
So, unless we see a spike in jobless claims, the three horsemen of the stagpocalypse won't ride. The bigger risk to investors isn't stagflation after all. It's a sharp pullback in tech stocks, the one sector still attracting outsized capital despite this global uncertainty. So how do equities keep climbing despite Trump's tariffs and the inflationary pressures that come with paying anywhere from 10 to 100% more for goods bought outside the States? I wanted Zyblock's take on the idea that price spikes are likely transitory, how the US dollar's safe haven status is shifting, and what an expected 100 basis point rate cut over the next year in the States will mean for the next leg of this rally. So what does it tell us about the equity market reaction when the US tariffs that are pushing prices higher are being offset by moderation, things like shelter costs and wage moderation for that matter?
The global equity markets have been pushing higher this year, despite the potential frictions posed by global trade policy. Equity investors seem to be saying that any tariff-induced inflation is likely to prove, let's call it transitory. Like I've said, global economic growth probably remains stuck in a lower gear, while inflation tracks a little bit higher than at least most central banks would prefer. But in this environment where corporate earnings will probably continue to expand and thereby raise the floor under share prices, earnings for the S&P. I think they're on pace for about 12% gains over the next year, 11% for non-US equities. And, if we don't see any lasting inflation shock, equity market valuations are unlikely to compress by a lot from their current levels. The sluggish labor market, we've been talking about, I think that should help keep a lid on wage inflation and overall consumer price inflation. So I think inflation will be manageable.
If a stronger domestic demand in the United States and a weaker U.S. dollar there increases the cost of imported goods, what does this tell you about the status of the greenback as that reserve currency? It wasn't until Trump hit office that we started talking about the possibility of decoupling from that relationship.
I do think, just stepping back a little, I do think there's a little bit more inflation risk in the U.S. than elsewhere. Like you say, America has stronger underlying domestic demand than that of many other major economies. And at the same time, the U.S. is effectively raising the price on all of its imports since it's imposing tariffs on everyone. So there's less opportunity for American importers to substitute away from these higher policy linked costs. And the US dollar, like you mentioned, has been weak, and that's only adding or is that exacerbating the cost of imported goods. But about the dollar specifically, a key change seen in the behavior of foreign exchange markets this year, particularly, has been this clear break in the relationship between higher U.S. bond yield spreads and a stronger trade-weighted U.S. dollar. In fact, spreads have been favorable to the dollar, and the dollar's weak. I think there appears to be a major sentiment shift among currency investors, whereby the US dollar is no longer being seen as the ultimate safe haven currency due to recent fiscal and trade uncertainty. Foreign investors, if you think about it, they hold about 18% of US equities, 33% of US bonds. They're feeling that they might be under hedged now. And hedge ratios on US dollar assets are now being raised from historically low levels. And this, I think, in and of itself, might be adding to the general selling pressure on the US dollar. But, let me be clear. I believe the US is not at risk of losing its reserve currency status anytime soon. There's really no viable liquid alternatives. The US possesses dominant network effects. 88% of foreign exchange transactions, 60% of foreign exchange reserves, and 50% of global GDP is in US dollars. So I'm not sure the US is going to anytime soon lose its reserve currency status.
It sounds like, considering the short-term weakness we have seen, that there's a play being set up here for a rebound.
The world has gotten really negative really quickly on the US dollar. So I think that, a little bit of this clearing up in policy uncertainty can help maybe stabilize the dollar for a while here. Yeah.
One of the things that's always fascinated me about rate moves is that a rate cut can be a good thing depending on the circumstances, and it can be a very bad thing as far as the market sentiment is concerned, again, depending on the environment. It sounds to me like you're telling me, one, Michael, media guy, the sky is not falling. Two, things are better than we think they are, and that the sentiment is what's truly negative. So if we do see those modest rate cuts by the U.S. Federal Reserve, what do you anticipate the reaction to be market-wise to that if things aren't as bad as the headlines suggest?
I looked at, speaking with the Fed, they've been on hold now for what is it, 6 months, right? They've been sort of just deer in the headlights, not sure about what tariff policy might do to growth or inflation. And so I looked at my Bloomberg terminal earlier today, and I saw fixed income markets have priced about 75 to 100 basis points of rate cuts from the Federal Reserve over the next 12-month period. The first rate cut is expected maybe to happen as early as the Federal Reserve's September meeting, so less than a month away. Meanwhile, most other major central banks are expected to reduce interest rates by another, say, 25 to 50 basis points over the next 12 months. So, the pace of monetary easing collectively is slowing a little bit relative to, say, 18 to 24 months ago. But capital costs are still coming down. And, as capital costs come down, I think at the margin that's going to help growth. And hence it should be somewhat beneficial for equity markets.
If I understand this correctly, what you're telling me is, despite protectionist headwinds that we're seeing in the United States, the global benchmarks are hitting all-time highs as inflation is only modest. Earnings are resilient, and maybe the S&P 500 jumps 12% on earnings. And we are getting some more clarity on policy, broadly speaking. Your point about the bond markets, the debt markets, if equity markets have a 6-month outlook, but the bondies are the ones that really take the longer term view on the world, how much longer does the equity run last?
The equity market is trading at a historically elevated valuation. I'm not going to say it isn't. The U.S. index, there's another issue, U.S. index concentration, as reflected by the fact that almost 40% of market capitalization for the S&P 500 is captured in just 10 stocks. So valuation, concentration risk, performance fragility, I think, for the global equity benchmark, which is 65% weighted to the U.S. stock market, is higher now than what has been typical. But again, this is a similar story to what could have been told last year, the year before that, or even the year before that. So, I think, keep in mind, ongoing corporate earnings expansion is becoming, I think, increasingly important for this market. Inflation must remain manageable. These are become musts now. At the same time, that investors keep their heads on their shoulders here. So, as valuations have risen, there's just simply less room for disappointment. So what I'm saying is that still positive, but obviously the risks have increased in certain areas of the market.
So, equity markets may brush off this tariff-induced pain, but Zyblock points out that we're at record highs, valuations are stretched, and the heavy index concentration leaves little margin for error. The rally's now relying on corporate earnings growth, as much as 12% year over year for the S&P 500. So how do we position our portfolios when there's no obvious hole-in-one opportunity? Zyblock tells me the answer: stay in the middle of the fairway with disciplined diversification until the conditions shift decisively. So I wanted to dig into his cross-asset strategy that includes high-quality corporate bonds and the one principle he says every investor should carry in their financial golf bag. Or if you're a terrible golfer like me, a beach bag, as the case may be. After everything we've said, at the end of the day, you're neutral across asset classes, no significant underweight calls, no significant overweight calls. What am I going to do? Just buy some stocks and go to the beach?
Well, Michael, I guess, doing this for 30 plus years, I'm in it for the long haul. I haven't seen the fat, let's call it the fat pitch. I've learned over the decades that you tend to want to keep your multi-asset portfolio aimed in the middle of the fairway. That's sort of using a golf analogy there, until you sense an extreme. And one example of this was when fixed duration asset like a bond was trading at a negative yield to maturity. So you had a guaranteed loss. And, there was $18.4 trillion of the sovereign market was trading at a negative yield to maturity only a few years ago. I think in 2020. That was weird. That was unsettling. That was a fat pitch. Today we have a lot of, in other words, don't hold bonds back then. Today we have, a lot of competing cross currents. In equities, earnings, like I said, continue to expand, but valuations are high. In bonds, yields are decent historically, but inflation risks are a little higher than average. So again, like I'm saying, there's no fat pitch, at least none that I can see, which is why the portfolio is allocated like pretty much straight up the middle.
We've got tech, as we've already talked about, outperforming the more defensive sectors, industrials as well. So how should investors be setting themselves up for 2026?
In the equity market, I've always been somewhat a little bit boring, let's call it. I stress diversification across industries and styles. It's often easier to know what not to own. And I've found it's important to be cautious of companies with PEs which reflect, say, the expectation of 20% plus earnings growth for say the next decade. Only 1% to 2% of companies in history have ever been able to achieve something like that. Avoid companies with challenged debt dynamics, interest coverage ratios below 1 for a period of a few years. These are the kinds of things. So, well diversified. Of course, we own tech. Of course, we own industrials. Healthcare has been one of the laggards, but I think there's some interesting value returning to the healthcare sector. So again, diversified across the sectors is very important.
For investors who recognize the importance of the bond component to their portfolio, the fixed income element, you are seeing corporate spreads tighten. But if I understand correctly, you see the spreads as being sustainable, attractive yields, unless we get an economic downturn, of course. So what's the signal that you need to see before you can say the run is done?
Spreads are really low. Corporate credit spreads are very low historically. I don't think that's sustainable forever. I'm going to say it's not sustainable forever. I do see these low spreads as sustainable for the foreseeable future. They usually flare out credit spreads on economic collapse or an exogenous shock, scenarios that I attach relatively low odds to right now. Corporations have continued to delever over the past few years, and that's been very helpful for the corporate bond market. That said, I think the absolute level of corporate yields remains attractive for a patient buy and hold type of investor. You don't have to take very much duration risk. You don't have to take very much credit risk to capture yields exceeding 5%. And again, this is pretty attractive relative to what we've experienced over the last 20 plus years. So, I'm not that negative on corporate bonds at all.
So then what do you say to a bond investor who has sovereign debt, the yields are at multi-year highs, and they're thinking about switching to corporate for the more compelling historical yields?
Credit spreads being low, that's a lot of people interpret that as I'm not being compensated for taking credit risk. So the bond market says, maybe I shouldn't be here. But like I said, a patient bond investor is probably not going to turn their nose up to a 5+% yield which is rated, a bond that's rated A or even higher, and you're getting 5% yield. So, my sense is that I like high quality corporate bonds here.
With our time together coming to a close, what's that one thing that an investor needs to know going into the home stretch of 2025?
I think that the one thing investors and their advisors need to keep in mind is that investing is a marathon, not a sprint. As Warren Buffett has said, in order to succeed, you must first survive. So, okay, that wasn't one thing, that was two, but there you go.
Hey, if you were an economist, it would have been 3 sentences.
Yes.
One last important question of everything that we've talked about here. Myles, are neckties back?
They're back only for you, Michael. They're back only for you.
Oh, well, very nice of you. Myles, great speaking with you as always.
It's been a pleasure, Michael. Thank you very much.
So there's the scoop from superstar portfolio strategist Myles Zyblock. He isn't betting on a single trade. He's playing for steady, sustainable gains by spreading risk across sectors and favoring high-quality corporate bonds that still offer attractive yields. For Zyblock, long-term success isn't about chasing the next market high. It's about surviving the downturns that inevitably follow. Now you're on the money. Thanks for sticking through the entire episode. Would you do me a solid? If you know someone who could use this podcast, can you forward it to them? If you do, Myles Zyblock will come to your house and paint it. Okay, maybe not. I'm Michael Hainsworth. Have a profitable day.